Bank of England has been 5.25% base rate since August 2023. So if you're buying property right now, should you be buying with a fixed or a variable mortgage? First of all, what are they? So you've got a few different things to be looking at. Fixed, variable, tracker, discount variable. So fixed is having a fixed rate. Now let me clarify, because I do get this question a lot. If you've got a 30-year mortgage, it doesn't mean it's fixed for 30 years. What it means is it's fixed for the duration that you fix it. And the most common is 2 years, 3 years now, 5 years and 10 years. Those really are the four options. Can you get them longer? Yes. The longer you fix for, the higher the cost will be, because obviously the bank is taking on a risk. So let's say you fixed at 5%, then you will be able to fix that for, let's say, 5 years. So that's what a fixed rate is. A variable rate, it can be a tracker rate. A tracker is tracking the Bank of England base rate. So let's say right now, at the time of filming, the Bank of England bank rate is 5.25%, which, by the way, is that high? Because I get a lot of questions. That's really high, isn't it? Interest really high. No, it's not high. It's actually below the average over the long term. Just so you know, the average is above 6%, but it's below the average, but it is higher considering we've been paying 0. Fuck all for the last 5 years behind. In fact, since 2007, it's been pretty much 0% interest rate. So we've just had it really, really, really good for a long time, and people just get a bit confused. So how does it work? So typically it'll be tracking the base rate plus a margin. So let's say it's a margin, which is their profit, of 0.75%. So if you've got a variable rate right now, it might be 6% as of the time of filming, because you've got the base rate of 5.25%, then they need to make their small margin. But let's say the Bank of England base rate went up to 6%, then it would be 6.75% to you. And it's monthly, and actually a lot of them are done on a daily base rate. So you've got basis points that go up or down on a daily basis. But likewise, if it went down to 4%, then you'd be paying 4.75% with the 0.75% on top. Hopefully that makes sense. Now, what you can get is a discount variable rates, where the banks will give you a bit of an incentive for the first 2 years to go with them. So they'll deliberately make the first 2 years cheaper, which is often at a loss to the bank, to get you as a customer, knowing that a majority of you will stay with them for the long term. So in general, fixed is fixing it in place. Variable is making sure you're going along, and it varies month to month. And often those are trackers, which tracks the Bank of England base rate. So what are the pros and cons? Well, if you fix something in place, like a fixed, you are banking on interest rates going up. And I will share my opinion on this, but it is only an opinion. So if you fix it today, let's say you could fix it at 5.5%, so it's making a bit of margin. It's important noting, by the way, that fixed rates, whilst the Bank of England base rate does make a difference, it's not directly what a fixed rate is based on. It's on swaps, and what this is trying to do is the banks are predicting the future based on their analysis, their economics, their actuarial scientists, whatever it is. They'll basically, and that's why you'll see fixed rate mortgages sometimes lower than the base rate. That doesn't make any logical sense, but it does, because they're trying to capture your business at a loss today, but they've got you over the long term. Hopefully that makes sense. So a fixed rate, obviously, it makes sense if you believe interest rates are going to be staying the same or going up. And so what that does is often you are protecting yourself against fluctuations. So that's tip number one and a pro. The other thing it does, as I said, is protect you against fluctuations. So let's say you know what you're dealing with. So even if you're paying a little bit of a premium, but you know you are getting £200 a month net cash flow, then you know you're going to be getting that for really 5 years. Because yes, you're going to have some maintenance, but you're also going to have rental increases over time. So that's the upsides. The downside for me is twofold. So number one, if it stays the same or goes down, you're ending up paying more than you need to on this particular property. But the big downside is you are fixed, trapped pumped into the mortgage. So let's say you got a 5-year fix and, well, two scenarios. Let's say you hated the current bank, or there's a big dip and some other banks are putting on these real like incentives for you to go get money for them. You can't do it because you're in a fixed mortgage, so you're tied into a contract. I'll tell you what that looks like in a second. Likewise, let's say something does come up where for whatever reason 3 years from now you've had a change of circumstances, you want to move halfway across the world and you want to sell your portfolio, but you're in the middle of a fixed contract. Bad news, you're going to end up paying an early redemption charge. I actually had this on one of my personal residences where I needed to refinance out onto a new one earlier, and I was going to get an early redemption charge of over £20,000. Even though I only had something like 8 months left, I got charged over £20,000. Well, I didn't, because I managed just to leave it and then deal with it after. But you have to be careful of early redemption charges. Now, what would I do? Well, this really depends. If I'm buying a personal property or an investment property, what I am doing is I am more than happy to do short-term fixes or variable. My personal belief is that interest rates are going to start coming down. Interest rates are deliberately applied to bring down inflation, and already in the UK, if you look at inflation today versus 12 months ago, it's gone down quite rapidly, and I think they've maintained it at 5.25% since August 2023 for a reason, because it's doing its job and they just really want to nail it home. Just my opinion, by the way, not financial advice. So for me, I'm happy with variable, and I'm also happy with short-term fixes. Now, if I've got a portfolio of properties, which I do, I like to fix about 60% of them and keep 40% of them on variable. That way it kind of risk mitigates me whether it goes up or down in a large thing. Now, the reason why I'm doing that is, maybe this is a bit naive of me, I just don't care about the cash flow. Now, do I want it to be able to pay all of the bills and make a drink out of the end of each month? Yes. But the main way that you make money in property is not from cash flow, despite all of the bloody gurus telling you that. You make it through capital appreciation, inflation, supply versus demand, product and price going up. So if the cost of labor, the cost of bricks, the cost of wood goes up, then the cost of the development goes up. If developments go up, developers need to sell it for more, it drives up the prices in the area. And love it or hate it, that is how you are going to become a millionaire. Not from the cash flow, it's from the capital growth, which is also tax-free, by the way. So it's not financial advice, it's just my opinion. Your situation is unique to you and you should talk to an accountant. But if you watch this far and you've actually got the money to invest in property, if you've got £50,000 or more and you're ready to build your portfolio and you want some direct guidance and our opinion on how to do that, and maybe we can actually help you build your portfolio in 2024 and beyond, then put APG in the comments right now. That stands for Aspire Property Group, and we can help you build your portfolio for you hands-free this year. Put APG in the comments or click the link in the description. I'll pin it to the top. I hope this has been valuable. If it has, make sure to hit the like button and subscribe to the channel if you are new. And of course, I'll see you in the next video.